Welcome students. So in the process of learning about the financial estimates and projections, in the previous class we just started the profitability projections or preparation of the profit and loss account, or say finding out whether the project is in the profit or in the loss, or whatever the maybe the number of products we are manufacturing. All the products are giving profits, all the products are giving losses. Some products are giving profits, some profits are giving losses. So maybe all kind of the say estimates we have to do. So in the profitability projections we started say talking about the initial things, that what important considerations are there while talking about the profitability projections, and then now we will take the things means the discussion forward. And when you talk about the profitability projections or estimation of the profits, so first of all, the first requirement is working out the cost of production. You see that when you prepare the income statement or profit and loss account, we'll see the format also in the subsequent slides. So when we prepare the income statement, we have two broad components. One component is the cost of production, which comes on the debit side of the income statement, and then second one is the sales or the revenue, and then the closing stock. So whatever the productions we make, that production ultimately has to go to the market. Maybe it's a production of a product, or maybe generation of service, or any other kind of the activity. We have to incur the cost for performing those business activities. So on the one side we keep the cost, on the other side we keep the incomes, maybe the revenues because of the or revenues generated out of the sales of the product. So comparing the sales with the cost and cost with the sales, we end up with the difference. So if the income side is bigger and the cost of production is lesser than that, so end result is the profit. But if it is otherwise, that the cost of production is more than the sales value or maybe the sales revenue, then we are at the state of the loss. So in this case, we have to say try to understand that before going to the venture capitalist or maybe for the different sources of the funding, we have to prepare the projected financial statements, and out of the projected financial statements, the profitability projections or preparation of the income statement is the first important thing. So we will prepare the projected income statement not for 1 year but for multiple years, maybe next 5 to 10 years period of time, so that we can show the trend of the cost, the trend of the revenues, the trend of the profit or the trend of the loss, how this trend is going on. And we have to tell the investors in which year we are arriving at the break-even point, and finally when we are starting earning the profits. So those projections will be prepared, projected financial statements will be prepared. We call them projected financial statements, we call them pro forma financial statements, we call them dummy financial statements. But these are, though we call them dummy financial statements, but they are based upon the data which is collected from different sources. For example, for sales data or for the revenue data to be taken to the income statement, we depend upon the market and demand analysis. For the say cost part of the data, we depend upon the technical analysis, because technical analysis entails the cost to be incurred on account of the fixed assets as well as the current assets. And in case of the sales revenue, we have to go for the demand estimates and forecasting of the demand for the goods or services we are going to prepare. So maybe are going to manufacture. So these two initial analysis, market and demand analysis and technical analysis, help us to prepare the projected financial statement, that is a profit and loss account, even cash flow statement and balance sheet. So first statement, projected financial statement, as we started talking yesterday, is the income statement or the say profit and loss account, where we will be projecting the profitability of the project or the venture, because it is very much required and very much helpful for convincing the investors, the venture capitalists or maybe the other sources of funding, that if you make investment in this project is going to be certainly a very good profit making proposition, and after the initial 1, 2 or 3 years of losses, we will arrive at the break-even point at the earliest, and then we will start earning the profits, and profits will also keep on growing. So we'll have to work out that profit and finally show that trend. So trend of the profit may be something like this: either it remains as a static, or it goes up. But if it goes down something like this, it means either we are at the state of loss, or if we are earning the profits. But in the subsequent years, maybe in the subsequent years, if for example the profit is declining, right? So here it is, the profit is going up, and here the profit is declining, here the profit is remaining static. So what is the trend we are going to take for the profits? that we have to show to the investors. So profitability projections and the income statement is a very, very useful statement, and they will raise many questions. You should be prepared for that. The investors will raise many questions that when you're talking about the sales revenue in the first year, what is the basis for that? How much you are going to sell, what is the total market available for your product or service, and how many existing players are there. So how do you think that maybe despite the existing players in the market, you will have 10% market share or 5% market share? What extra you are going to give to the customers so that they move towards you and they become the former customers for the existing suppliers? As in case of Jio or maybe this mobile telephony, when the Jio this moved to the mobile telephony or came out with the mobile telephony, Jio Mobile came to the market. So they knew it that they are going to venture into a market which is having the four best, call it as established players in the market. So they are going to be the fifth player in the market, and as a fifth player in the market, to have the sizable market share, they have to give something extra to the people. So they gave the services free of cost for the initial 6 months, and the quality of service was very good as compared to the other players in the market. So as a result of that, they could establish themselves in the market, and in a period of a short span of 9 years, now the Jio is the second largest mobile telephony provider in the country. Similarly, when you talk about many other products, manufactured products or maybe services or maybe your other things, so there you have to give something extra to the people if you are going to venture into the market which is already having the existing players, and you are going to be the another one, maybe out of the 4 or 5 players, you are going to be the 6th player or maybe the 5th player in the market. In that case, you have to give something extra. So these questions will be coming to you from the investors in the presentations, and they will ask you that how you projected this revenue, that you are going to have this much of the revenue, this much amount of the sales, when existing players are already there in the market. And if it is a new project or maybe a new product or a new service at all, it's already not there in the market, right? So in that case also they will ask many questions that maybe since it's a new product, people don't know about it, and India is a price sensitive economy, and people have the limited income to spend upon the, say, the necessities, comforts and luxuries. So your product range falls into which category? Is it a necessity? Is it a comfort? Is it a luxury? And if it is even a necessity, why you are going to come out with this product, and what extra you are going to give it to, why people should buy your product. So at the time of maybe when the Anchor Fruit Beer was launched in the market, many such questions would have come in front of the company, though they were not requiring any investment from the market, maybe in the form of the venture capital or maybe in the form of institutional finance. Still, their own funds were a scarce resource, and they must have asked such questions. Their consultants must have asked such questions from them. Even the company's management, company's board must have also asked such questions, that a product like fruit beer, when we are going to come in the market with the product like fruit beer in the Indian market, do people like this kind of the products? Do people have the sufficient income to buy luxurious product like fruit beer? Because fruit beer is a kind of a luxury for we people in India, because we have a limited income and we are highly price sensitive. So whether it's an existing product or existing service, or it's going to be a new product or a new service, if you are going to depend upon the external sources of funding, maybe in the form of the venture capital or maybe in the form of the institutional finance, such questions are going to be there. You have to answer these questions, and you have to be very careful that you should have appropriate reply to the investors' questions. So in the projected financial statements, when you are preparing the projected financial statements, we are going to calculate the cost of the production out of the total production estimates. And production estimates we are going to get from the market and demand analysis, because there we have got the estimates of the sales that we are going to make in the market over the years, first year, second year, third year, fourth year, fifth year, so on and so forth. So since we know the total saleable volume, we have already worked out. So accordingly, we will be working out the production amount or the volume of the production, and accordingly we will work out the cost of production, and finally we will arrive at something that sum total of the variable cost and fixed cost is going to be this much for the given volume of production, and looking at the number of units we are going to manufacture, we will calculate the per unit cost. So as it is written here, while calculating the cost of the production, you have two broad components, right? These are the two broad components, variable cost and the fixed cost. First component is the variable cost, which is very much important. And if you want to control the cost of the product, this component is only important for us, right? because variable cost can be controlled. If you control the variable cost, certainly overall cost of production is going to remain under control. But as far as the fixed cost is concerned, you have no control upon the fixed cost once it is incurred, because you have to incur a minimum amount of the fixed cost. Once it is incurred, it cannot be altered. It is called as kind of a sunk cost, and whatever the control you want to have upon the cost, you want to increase or decrease the cost. You cannot increase the cost, you would like to decrease the cost anyway. So, you have the total control on this cost, which you can control the material cost, you can control the labor cost, you can control the utilities usage and cost, and you can control the factory overheads cost, right. So, these costs are the variable cost in nature, so you can control them. And normally these costs, because they are maybe as per the production, if you go for the more production, more material will be required, and if you are going for the more production, more labor will be required, utilities will be required, factory overheads will be required. So, it basically have a linear relationship, right. It has a linear relationship with the production volume. So, larger the volume of production, larger is going to be the variable cost. But your smartness can be that you have to look for the sources of the material where it is available in the bulk and maybe at the lesser price. So, the material cost can be kept under control, right. So, for example, as we were talking about that mustard oil manufacturing unit, if you want to establish that. So, I was telling you in that discussion also, I discussed with you that the mustard seed should be acquired, number one, in bulk, in big volumes, during season, because it is agriculture product, and directly from the farmers. If you do these three things, right, so the material cost is going to be sufficiently going to remain under control, and only variable cost can help you to control the overall cost of the product. Labor cost is variable, but controlling the labor cost is somewhat not in our hands, because it depends upon the labor market rates, and most of the times they are out of control. Some external forces play a role in deciding the labor rates. So, demand and supply of the labor, especially in case of the say skilled laborers. Skilled labor is very expensive, even semi-skilled also is very expensive. Only you can have some control upon the unskilled labor if it is a large in the supply. So, in a country like India, we have the luxury of having the cheap labor. So, in many cases we can reduce the labor cost also. So, if you want to control the cost of the product, you can focus upon the second important component also, that is the labor cost. Then we have the utilities cost, that is your water, power and other kind of utilities required for manufacturing the say product. So, there you can have the judicious use of the electricity or the water or maybe the other kind of the utilities, so that the total cost of maybe input cost remains under control. And similarly, the factory overheads. The factory, these are again two kind of fixed and variable. So, here we are talking about the factory variable overheads. So, the factory lighting, factory water, some lubricants we are requiring in the factory, factory labor, all these are the factory overheads which are variable in nature. There are certain overheads which are fixed also. So, you do not have any control upon the fixed overheads, but yes, the variable factory overheads can be kept under control. So, all these four components which are going to make the total variable cost, material cost, labor cost and utility cost and factory overhead cost. So, these four components of the variable cost can help you to keep the cost of product or the production under control. As far as the fixed cost is concerned, which can be incurred on account of the factory, for example, the factory building. Once you have a factory building, now you use that building to the fullest extent, you do not use that building to that extent, you have to pay for the depreciation. If it is a rented building, you have to pay the rent for the whole of the premises. Similarly, you talk about the administrative overheads. Administrative overheads are basically incurred in the office. The salaries of the permanent employees, the expenses in the office buildings, the lighting in the office building, the water in the office building, the depreciation of the office buildings, or if it is a rented space, the rent to be paid for the administrative buildings. So, all these administrative overheads are going to play the role, which are largely fixed in nature. And then we have the next component, last component, selling and distribution overheads. Selling and distribution overheads are also partly variable and partly fixed. So, the variable overheads, for example, when we pay the salaries to the salesmen, so there are two components. One component is fixed, which they get the salary. which cannot be reduced, but we have the variable component that if you cross this much level of the sales, we'll give you the commission or we will give you some variable incentives, so they can be controlled. So there can be some possibility, commission can be controlled, the incentives can be controlled, so variable part of the selling and distribution overheads can be controlled. You can control the advertising cost, you can control the even distribution cost also. You can have the long-term distribution contracts with the distribution companies or maybe with the your channels of distribution. So the variable component can be taken care of, but as far as the fixed component is concerned, it cannot be controlled. So ultimately, purpose is that whatever this cost of production we are going to have, we have to control the cost of the production, and if you are able to control the cost, you are going to control the price. So price has to be under control in any case, whether it's a new product at all or maybe it's an existing product which is already there in the market and is being provided by the existing players in the market. If you have the lesser price, maybe half of the battle stands won. Means you don't need to worry about that. For example, when you talk about the Nirma washing powder story, Karshan Bhai won the battle largely because of the pricing of the product, because he priced it for 10 rupees a kg when it came as a branded product in the market. At that time, the products by the Hindustan Unilever, Surf and Sunlight, were very expensive products, and he could win the heart of the people. He could sneak into the market, he could penetrate into the market, and he made his mark in the market. So quality was one thing, but quality was not comparable to Surf, because Surf is a very premium product, but still Nirma also met the requirement of the people, sufficiently met the requirement of the people. So people were satisfied with the quality and more satisfied with the price. So that was the reason that it could dent or it could disrupt the washing powders market in a country like India. And after that, series of the washing powder, cheaper range of the washing powder came in the market, and even Hindustan Unilever also had to introduce a cheaper range of the washing powder under the brand name Wheel. Right, that was a compulsion because they had to compete with these cheaper range of the washing powders after the introduction of Nirma and so many other products coming in the market. So they also had to. They continued with the Surf, but they discontinued to some extent or reduced the production of Sunlight, and then they introduced a very cheap washing powder comparable to Nirma that was under the brand name Wheel. So cost of production is a very, very important thing. When I talk to you about the Kabir Mulchandani story, so Akai TV, when he brought in the market, he disrupted the CTV market by reducing the price. And the secret of that was he didn't put up any plant or machinery. He reduced the depreciation element completely, and he assembled the product by taking the ready-made components from the market from Taiwan in bulk, and he could sell that color TV for a very, half of the price, less than half of the price as the Samsung, LG and Sony were selling in the Indian market. And important reason for the failure of the Indian players, or the reason for going out of the market, why the electronics manufacturers, Indian companies and the companies like Vodafone, this Onida, who were having about 45 to 50% market share before the liberalization of Indian economy, even up till 2001, 2002, after the liberalization of the Indian economy, even 10 years after the liberalization of Indian economy, these companies like your BPL, then Vodafone, then Onida, they had about 45 to 50% market share, but that kept on declining, and finally the product went out of the market because they couldn't control the cost, they couldn't improve the quality as compared to the multinationals products of the Samsung, LG and Sony. So finally what happened, that these established players went out of the market because people slowly rejected their products and they accepted the products of the multinationals, and as a result of that, because of the very good quality product at a reasonable price and because of the competitive electronics markets, we are getting all these say electronics products at a very, very reasonable price, and even this market to a larger extent was disrupted by the Chinese products. You understand, Chinese products may be not good in quality, but they are very low in price, and they disrupt the market many a times. Mobile telephony, for example, in the smartphone market, they have a very significant market share where no maybe Korean, Japanese or American company could compete with the Chinese products. So what is the love for the Chinese product? Quality we all understand, but the first important factor is the price. The price is so much under control that people love to buy those products. So here also, the secret of the success of the new venture is going to be, whether it is from the startups or it's going to be from the existing companies, you have to keep the cost of product under control, cost of service under control. If it is under control, certainly you are going to maybe win the situation or win the market. Whatever the products have been in the market or whosoever have made the mark in the market, that has been possible because of the managing the pricing component, not by the say maybe the any other thing. Other things are important, but first we go in a price sensitive economy like India, first we go for the price. So you have to, as an entrepreneur, as an owner of the new venture, you have to, if you want to see your profit, see this as this trend is going up like this, right? So you have to keep the price of the product under control. If you are able to control the price by controlling all these variable costs, right? These four components of the variable cost. If you are able to control the variable cost, if you are able to control the overall cost of the product, certainly you are going to win the battle and you are going to make the mark in the market. So always focus upon that and try to introduce a product or a service in the market which is within the range of the people. So cost of production is the one component in the profitability projections, and we have these two broad components of the cost, variable cost and fixed cost. And variable cost is composed of material cost, labor cost, utilities and factory overheads. Fixed cost is composed of the factory overheads, administrative overheads and the selling and distribution overheads. So finally, to calculate the cost of the production, we have to prepare this kind of the cost sheet. And this cost sheet or statement of the cost is prepared for every product individually, right? Every product individually. We have to prepare this for the every product individually. This is not a common cost sheet. This is required to be prepared for every product we are going to manufacture. If we are going to manufacture only one product, then only one cost sheet is required. But if you are going to manufacture multiple products, each variant of the product, each model of the product requires an independent absolute cost sheet, statement of the cost. And for that purpose, maybe you have to calculate the total cost of the product. So when you see this cost sheet, what it includes? It has a four sub costs you can say. First one, this is the prime cost. We have the works cost, we have the cost of production, and this is the total cost or cost of sales, right? What constitutes the prime cost? These three components: direct material, direct labor and direct expenses. As we saw in the previous slide, these three components are the important components, and if you want to control the cost of the product, you have to start from the variable cost. Material cost is a variable cost, labor cost is a variable cost, and expense cost is a variable cost, which in total makes the prime cost. Factory overheads are partly variable, partly fixed. Even administrative overheads are partly variable, partly fixed, and even selling and distribution overheads are partly variable, partly fixed. So we have to control the variable component only because we have no control upon the fixed cost. And even in that case also, when you want to control the cost of the product, you have to use the mechanism of the cost and benefit. Because if you make the effort for controlling the cost, so what is the result? If the efforts are much more and the result is going to be very less, then there is no point spending time, money and resources for controlling the cost that way. For example, when you talk about the material cost, direct material cost, if you want to manufacture any product and the material cost is, say for example, 60% of the cost of the product, and it is normally there. In any manufactured product, 60% up to 60% of the cost, total cost of the product is because of the material. So if you are able to reduce the material cost even by 10%, in the total cost you will be able to reduce it by 6 rupees. Or for example, if it is for the 100 rupees, the product cost is 100 rupees and 60 rupees is because of the material cost. So it means if you are able to reduce the material cost by 10%, it means in the overall cost of production you are able to reduce the overall cost by 6 rupees. So that makes sense that you are spending time, you are spending resources and you are achieving the significant reduction in the total cost of the product. That's very good. But if you are spending time, for example, the direct expenses, which only are 2% of the total cost of the product, out of 100 rupees, 2 rupees are because of the direct expenses, and you make huge efforts to reduce the direct expenses and you reduce 10% of the direct expenses, how much you are going to save ultimately? 20 paisa. So don't make efforts on say reducing the cost like that. So look at this, out of these all components, which component has the largest chunk of the cost? Focus upon that and try to reduce it. If you are able to reduce it even by 5%, 6% or 10%, a significant impact will be there on the total cost of the product, and the total cost of the product will certainly or significantly come down. So here we have divided this cost sheet into the 4 sub costs. First, we calculate the prime cost, which is the sum total of the three direct expenses, variable expenses, material cost, labor cost and direct expenses cost, which makes or which helps us to have the prime cost. Then we have the works cost. Into this prime cost, when we add the factory overheads, because when material goes to the factory and we start processing it, after incurring the fixed and the variable cost, we convert that into the semi-finished product. And then from one channel to another channel to another channel, finally from the one stage to other stage to other stage, the product is converted into the finished product in the factory. And then finally, to take the product from factory to the market, you have to perform some activities which are called as the commerce activities, which are performed to take the product from the or service from the place of production to the place of consumption. These activities are called as the commerce activities, commerce related activities. Administrative overheads are also the part of that particular kind of the expense after manufacturing the product when it has go to the market. So you have to incur the administrative overheads, which are again partly fixed and partly variable. And finally, when you have to take the product to the market, so you have to incur the selling expenses, distribution expenses, advertising expenses, warehousing expenses, sales commission to the selling force, dealer's margin, everything you have to incur. So they are again called as the selling and distribution overheads. So total cost of the product is divided into the four sub cost: prime cost, works or factory cost, cost of production and total cost or the cost of sales. Why we divide this total cost into the four sub cost? Because if you want to control the cost of the product, you have a very clear idea, very good idea here about that which component is causing the higher amount of the cost. If you focus upon that and you make efforts to reduce that particular component, so your total cost would be significantly coming down. For example, if we see from this analysis that your prime cost is very high, right? So it means which component in the prime cost is very high? Is it a material cost, labor cost or direct expenses? So we have known it, that component which is causing the extra cost, we can control that. Similarly, if we come down that say prime cost is okay, but the factory overheads are very high or we are spending more at the factory level. So we have got a clue and we can reduce the factory cost or we can focus upon reducing the factory cost. Sometimes, for example, if the administrative overheads are very high as compared to our competitors in the market, for example, so we can focus upon the administrative overheads and we can reduce that cost, or similarly we can control the selling or distribution overheads or the cost if it is found to be very high. So because we want to control the cost, so we have divided it into the four sub costs and we are getting a very clear idea at what level the cost is increasing, right, so that we can hit upon that particular part and control the total cost of the production. So cost sheet or the statement of the cost is a very useful document, and for every individual product which we are going to manufacture in own say this venture, we have to prepare a cost sheet or statement of the cost, and we will have to use this for controlling the cost of the production. This is a very secret document, right? This is a very confidential document. If you want to prepare the cost sheet, if you prepare the cost sheet, number one, it's very complex document. Once you prepare it, you keep it very safe and with the people who are responsible people in the organization, and don't share it with anybody, because your competitors have come to know that what is the secret of your cost of the product getting down, significantly getting down, so they would also follow the suit and they will also reduce the cost and become your competitors. So we never share this. It's highly confidential document. People send the spies, firms send the spies from their place to the other firms, to their competitors for some amount of time. They get access to the cost sheet or statement of the cost for one particular product, which is their target. They get that and they come back to their parent organization. They get an idea then that how the cost of production can be controlled, or our competitors are managing the cost of the production. So very important document, very complex to be prepared and should be kept as confidential, because it's going to give you the competitive edge. So cost sheet we prepare and we work out the detailed cost for the product which we are going to manufacture, and this is on the one side is an instrument, is a statement for working out the cost, detailed cost for the product or service which we are going to manufacture, and on the other side it's helping us to control the cost as well, right. So this is a cost statement or statement of the cost, and this is a very useful document. After that we have the working capital requirements and its financing. So this is the next stage and this is the next requirement. So in this case maybe we will be talking about that how the working capital is required. So, for at this level, when we are talking about the profitability projections, we have found out here that the total cost of production will be worked out. Sales value will also be available with us as per the current market prices. So, we will make a comparison between the cost of production and sales, and then we will try to find out that at the end of the year we are ending up with the profit or loss. If there is a profit, how much is the profit? If there is a loss, how much is the loss? And when we are going to arrive at the break-even point. So, with this discussion for this particular class, we will stop here, and we will continue the discussion on the financial estimates and projections and subsequent relevant parts, maybe the cash flow statement or the balance sheet, and even the practical part of this profit and loss account, or maybe the cash flow statement and your balance sheet, that we will discuss in the subsequent classes or subsequent discussion. And continuing this discussion, we will continue this discussion to the next class also. So, before we go to the next class and we start talking about the subsequent part, we will stop here, and we will resume the discussion in the next class. Till then, thank you very much.